Welcome everyone, happy Tuesday. This is our last webinar for the year, so I do want to thank you all for attending today, but also for joining us throughout 2022. It is top of the hour, so we're going to go ahead and get started. I do want to be respectful of your time. I'm Reneika Lightbourne, and I'm delighted to have Mr. Zhang, CEO and co-founder of PennyWorks. Thank you once more, Ivan, for being our featured speaker today.
Thanks for having me.
Absolutely. So Ivan's going to educate investors on how they can use it or how they can grow their self-directed IRA through investing in digital assets or digital asset lending. But before I turn it over, I do want to kind of give you a brief overview of self-direction as a whole, talk through the different steps in terms of when you're ready to get started with your account with us at Advanta. If you have questions, feel free to type those in the question box. We'll answer throughout and also allocate some time at the very end as well. So again, my name is Reneika Lightbourne. I'm one of the business development specialists here with Advanta. I'm in the Atlanta office. I've been with Advanta as an employee since 2019, but I'm also an active self-directed IRA investor. I'm also an Advanta client prior to joining staff. If you have specific questions in terms of wanting to do a deeper dive in your scenario, you're welcome to send me an email, give me a call, or visit us at advantaira.com to schedule a consultation. So just a little housekeeping before we get started. At Advanta, we don't give any tax, legal, or investment advice. Just know that all of the information that's going to be presented today is just for educational purposes. So as always, we encourage you to consult with your professional team, like your attorneys, your CPAs, and financial advisors before making any investments. So quick takeaway points. Just know that any IRA or former employer plan qualifies to be self-directed. You choose which investment you want to invest in. I know today we're going to be focusing on digital assets, but with self-direction, you have that diversity that allows you the flexibility to invest in cryptocurrency or precious metals or whatever it is that you choose outside of a few restrictions. And then know that any income that's generated from that investment flows back into the retirement account. And if there's any expenses associated with that investment, it's paid by the retirement account. So just a little history about Advanta and who we are. We've been in business for about 20 years now as one of the leading self-directed IRA administrators in the business. Our headquarters is in Largo, Florida, which is the general Tampa Bay area. Advanta has an office in Atlanta. Again, that's where I'm based. But we do work with clients nationwide as we have well over $2 billion under our administration. If you have cash that's sitting in your account with us, do know that it is FDIC insured. And then also too, with Advanta, we separate ourselves by providing our clients that concierge style service where you have a dedicated account manager, a direct point of contact that's going to be with you for the life of your account with us, but also to our educational content where we have guest speakers and subject matter experts like Mr. Zhang coming in to knowledge share with you. So in addition to hosting weekly webinars, typically on Tuesdays and Thursdays, we also have our Pitch Promote Prosper, which is every other Friday. My colleague Alex also hosts a podcast, so you're welcome to check out our website to see our upcoming events for 2023. All of our webinars is recorded, so you can always access that using our YouTube on-demand channel. And also our blog is a great resource for the latest industry news and trends. So exactly what is a self-directed IRA? Just very simply, a self-directed IRA means that you as the account owner, you're going to have complete control over the retirement funds, you have complete control over the investment decisions. It really allows you to diversify outside of the typical stocks and bonds. So again, today I know we're focusing on digital assets, but you can also use IRA funds to invest in oil and gas, private lending, equipment leasing, and so much more. So why do people choose to self-direct? You may look to self-direct for many different reasons. I'll just touch on 3 of them. One of which is it can be a new source of capital for you. So instead of taking money out your personal, savings or taking out a personal loan, you can elect to move those funds that's in your IRA or old 401k to make your next investment. And then, of course, the stock markets, the ups and downs, you want to be able to diversify. Well, self-direction is a good tool for that. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your retirement account tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the accounts that you're already familiar with. For individuals, you have traditional IRA, which is pre-tax dollars, Roth IRA, which is post-tax dollars. As long as you have earned income, you can contribute to your retirement account. If you're a business owner, entrepreneur, or have a side business, you can certainly look to self-direct SEPs, simples, or solo 401ks. Solo 401ks have the higher contribution limits, have greater flexibility. In addition to solo 401ks, some lesser known accounts that can also be self-directed are educational savings accounts and then HSA to cover medical related expenses. As long as you have a high deductible plan, you can look to self-direct that HSA. And then of course, any former employer plan, whether it's an old 401k, 403b, TSP, or pension type plan, you can self-direct. The key thing to remember is with the Roth IRA, the distributions would be tax-free at retirement, as long as you've had that account for at least 5 years and you're at retirement age of 59 and a half. For contributions, as long as you have earned income, you can make a contribution to your plan. So for 2023, we're going to see, we do see an increase in most of the accounts. So for example, for traditional and Roth IRAs, if you're under the age of 50, you can put in $6,500. If you're over the age of 50, you can put in an additional $1,000, so it'll take you up to $7,500. If you have a SEP IRA, you can contribute up to 25% of your income, your earned income, so $66,000, not to exceed $66,000. For a solo 401k, you get to contribute as an employee, but also the employer match, which allows you to put in $66,000 if you're under the age of 50, or $74,000 if you're over the age of 50. With the ESA to cover educational related expenses for your kids, grandkids, and so forth, you can the contribution for that will remain the same at $2,000, so $2,000 per year per child. For HSAs, we see a slight increase for individual plans, $3,850. For family plans, $7,750. If you're over the age of 55 for an HSA, you can put an additional $1,000. So when you're ready to get started with us, it's 3 simple steps. First and foremost, you would fill out the application. You can do that directly on our website, or you can reach out to myself or one of my colleagues, and we can get you that DocuSign where you complete it electronically. And then, of course, we can pair you up with a dedicated account manager. We'll get your account open within that 24 to 48-hour period. In terms of funding, you can fund by transferring from an existing IRA, doing a direct rollover from a former employer plan like an old 401k or 403b, or you can also make an annual cash contribution as long as you have earned income. And then finally, step 3 would be start investing. What is it that you want to invest in? Is it, digital assets? Is it, precious metals? The list goes on and on in terms of what's on the table for you. And with that, I'm going to go ahead and turn it over to our speaker, Mr. Zhang. So just bear with me as I make him the presenter.
Hey guys, can you hear me?
Yes, we sure can.
Great. So thanks everyone for joining us. Obviously, it's in the holiday spirit, so I'm sure everyone wants to take it easy towards the end of the year. This is a very interesting, exciting topic for me, but as we go on in the next few years and decades, I think it has the potential to be a paradigm shift similar to how internet came out in the late 1990s. So let's get started. What we are, PennyWorks, rocket fuel for your money. The idea is that we want to bring more agency and control of your money to yourself. And you can do that with digital assets, and we will show you how. So similarly to Reneika, there's a few disclaimers. We are a US-based company following all the regulatory requirements. Some of our products that we're describing here are Reg D 560 securities. And this is just information presentation. It's not a solicitation to purchase securities. All right, so overview, what is PennyWorks? So we are an investment platform, and the key benefit that we offer is access to higher yields in US dollars to collateralize lending of digital assets. So it's very similar to if you were a bank and you were lending somebody money, but in exchange you have a house, so that in case they don't pay you back, you can take the house, sell it, and get your principal back. And it's important to be collateralized because that means that you have security. You have an ability to make good on your principal regardless of what happens with the creditworthiness of the person. So we've been founded in 2021, and our own background is in traditional finance with a consistent track record of risk management. So what are we trying to solve for? So it's a recent dynamic that rates have been going up very quickly, but over the last 30 years, yields have essentially been a one-way line down. So since the late 1980s, yields, 10-year, 30-year Treasury yields were in the high double, teens, right? And so that was a great opportunity where you could buy this, lock it in for 30 years, and when rates go down to zero, you're still earning that 15% coupon. Well, recently, things have been changing. Market's been a lot more volatile, which means that you want to be able to make these investments. But a lot of people are retiring around this time, and they want to have dependable income. And it's very difficult to do that if you're just investing in stocks. You could make investments in the bonds, but that requires you to much longer term investments. A lot of real estate have 3 to 5 year lockups, so sometimes they tell you they can withdraw within a year, but then it's not really a guarantee. Or if you want to get the yield targets that you like, you need to maybe take a significant amount of credit risk, and that ends up being you making investments that are essentially unsecured loans, which means that there's nothing backing it other than the creditworthiness of the person or entity that you're lending out. Or lastly, if you don't want to deal with any of those things, you just put it in a bank checking account. You essentially get very little yield. So those are all pain points for many folks that are looking to generate some dividend income, but not willing to take a significant amount of risk to get there. What are the options available? Well, that's why we think that there's a huge opportunity for us. A lot of folks are just saying, hey, look, I'm just going to put it in my bank account. I'm putting US money market funds or something like that. These accounts have balances from 2.6 trillion to 33 trillion dollars. So, it's a very established market that people have been investing in, but typically have been very, very, very low yield for very conservative folks. So, is there a way we can get something that is equally safe but has a meaningfully higher yield? And that's kind of what we've been observing here with the decentralized asset lending, that there's an opportunity to do that. And part of the issue is that, as you've seen,
excuse me, I think if I can interject really quickly, it sounds like you're muffled. So I don't know if you're able to adjust your headphones. It's just some of the feedback I've gotten.
Sure, let me see if I can raise my volume. Okay, so my volume is raised. It's fine. Hello?
Okay, do a test. Yeah, yes, let's.
Okay, great. So I'll also just try to speak up a little bit louder. That'll help the audience here. So this is a very interesting chart. This is data that's essentially pulled by the government. And it's a survey that says, hey, look, what does it look like in terms of cash balances? Where are you holding them? So a lot of folks are actually holding a significant amount of cash on their bank accounts. And that amount has been growing since 2013-ish. And it's only gone even higher in the recent periods because of COVID stimulus checks and other structural changes into the economy. And so those folks here, they have all this cash and they're like, well, I don't know what to do with it. Well, what can I earn interest in? And unfortunately, prior to 2022, you could just put it in a checking account, or even if you bought money market funds, you'd be earning next to nothing. And so that's definitely a pain point for a lot of folks that work their whole career, retiring now, and need that dependable fixed income that they're not able to generate that. Moving on to the next slide. This is the macroeconomic picture, and that's the one that's going to be driving all of the concerns that most people are having these days. So as we mentioned before, if you look at the 1980s, right, you had a period of time where inflation, yes, was very high, right? So in the high double digits or medium double digits, but you also had 10-year treasuries that will actually pay out relatively a similar amount of money. And that matters because inflation is fleeting, right? So if you see at the peak in the 1980s, it goes back down to closer to 10% in 1990s. But if you had bought the 10-year treasuries when they were at the beginning of the 1980s at 15%, you essentially locked in 15% for the next 10 years. So you handily beat the inflation relative to your peers. And you could have done most of this there for nearly the last 2 to 3 decades. And not only were the absolute levels of yields higher, right, but you were able to lock it in for longer term. So this red line was consistently higher than this blue line that was showing inflation, which means that you will be able to generate real income. Your investments were growing at a rate faster than inflation until since COVID, right? So now post 2020, we see a massive bout of inflation as a result of supply chain bottlenecks, other structural changes in the economy, and long-term rates have not been able to catch up. So if you're buying a 10-year treasury now, you're getting something like 4%. You're locking that in while the inflation picture is a lot worse, right? 7.5%, high 6% in the last recent readings in the core CPI. That means that you're essentially losing 2% a year by buying 10-year treasuries, and you're also committing to that for 10 years. So it's a lot more risky now to invest in fixed income instruments than it were even just 10 years ago. What are we to do? And that's kind of what we're trying to do and solve this problem for a lot of people concerned about the fixed income picture. And the issue is, it's not something that's fundamentally impossible to solve, right? Banks could just say, hey, look, we're going to invest in treasuries, or we're going to invest in money market funds, and any rate increases, we're just going to pass through to the customer, right? And what you see is that they're just not doing that. So on this axis here, these are percents. So when they say 0.05, I don't mean 5%, I mean 500th of 1%. So essentially, banks are literally paying you next to nothing, and they're using your money to then generate income, and then they're effectively keeping all of that interest income. So if you think about as a partnership, or okay, the bank is safeguarding your funds, but you're providing them funds for them to make money, maybe you get like a 50-50 split, 40-60 split, maybe even 30-70. Well, that's not the case. This is more like 99% goes to the bank, and then maybe you get a little bit afterwards. So this is just an extremely unbalanced situation, and largely is the result of the fact that most banks are awash in cash. So they don't really need to compete for deposits, which means that they can offer very low rates, and you will still stay there because you need to use your ATMs, you need to use your mobile banking app, and all of your bills are connected to it. So there's definitely a lot of frictions to switching. And they're really banking on that to make sure that they don't have to pay you much higher interest rate. Right, so what is our solution? We provide a regulated private investment, which is a security that allows you exposure to digital asset lending. And there's a huge benefit because you have no direct market risk exposure. You're not buying Bitcoins, you're not buying crypto, you're not really betting that it will go 100x. You're just providing lending facilities for those people engaged in that business, right? These loans are over collateralized, which means that you will lend out 75 cents for each dollar or more that the borrower is putting up. And because you have access to daily liquidity, you're able to monitor the investment 24/7 and be able to close out the investment anytime they're remotely close from not being able to meet their interest rate commitments. And the last thing is that the yields are meaningful. So you're actually able to get something around 5% as opposed to 0.05% in your bank account. And the final point is that there's a much simpler to deal with than to actually do this yourself. The nice thing about decentralized finance and blockchain technology is that it's permissionless. So all the stuff that I'm saying, in fact, that we're pretty transparent about, is that you can do all the activities that we are doing yourself without the permission of anybody else. You don't need a license. You need to set up any expensive software, but you will not be able to get those tax benefits because based on the way that the laws are structured in terms of IRS, you're only able to get these tax benefits simply because through an IRA, you're investing in a security that's generating interest income. If you're doing this yourself directly on the blockchain, you would not be able to get that tax recognition. And so what does that look like? A lot of these forms, investments are kind of black box. You sign a lot of documents, you write a check, and then you're kind of just done. So what we've done is basically make this a little bit more straightforward in terms of being able to see every day, in fact, every second of the day, how much interest income you're earning from this investment. The investments are paid on a daily basis, and interest accrues essentially on a compounded basis because of that. Here is a comparison of the stablecoin lending market as opposed to some of the other things that you could be doing with the money. And as I said, as an investor, and as Reneika pointed out, diversification is very important. So you need to figure out what are the factors that are really important to you in terms of your investment goals. So stablecoin lending, what stands out about it is that it has very low market risk. Fixed income funds, so those are familiar with some of these long-term bond ETFs. There's one called TLT, which essentially buys like 20-year plus treasuries, and those things are highly volatile. Every time rates change by 1%, because of the very long durations these investments have, they change by 20 times that. So, for example, rates went down like 10 basis points or something like that, and some of these funds are down like 1.5% on a day. And so, for somebody that's looking for fixed income, you really don't want to be able to have to weather those kind of market risks, even though you're investing in fixed income. Some of the other platforms that do have compelling investments, like crowdfunding and securitized notes, they are very similar in characteristics, but the issue is they are illiquid. They don't provide access to the capital for maybe 6 months, a year, even longer. The nice thing about digital asset lending is that it's done on a block by block, which is almost on a 15-second basis. That means that you're able to access this cash. If you feel like you find a new investment that's much more interesting, you're able to pull out the entirety of the investment at any time. Your interest accrues on a daily basis. So there's really no commitment whatsoever, what allows you to get the flexibility you need in case you find a better investment elsewhere. And the last thing that I want to talk about, as most people on this call will be familiar, most of these private investments are not FDIC insured. If you invest in real estate or something like that, none of these things have FDIC insurance. Is everyone good so far? Cool. So now I want to explain what digital asset lending actually does, or how can you do it. So it's really similar to, imagine like a lending club, with some people are familiar. There's a marketplace. So some people say, hey, look, I need $10,000 for my own project or my investments. And then there are lenders on the other side that says, hey, look, we'll be able to lend you $20,000, $10,000, so on and so forth at a particular rate. And these lending marketplaces, instead of being on the web, which they technically are, they are on the blockchain, which means that all the mechanics and the operations of how you settle the accounting, how you get paid, and how people can call back those collateral is done by a thing called a smart contract. But fundamentally, when you invest through it or use us to invest for you, this process is very straightforward. It's just like a regular dollar investment. You send funds in. The funds need to be converted into blockchain dollars, which are called stable coins. And once these stable coins have been converted, you can then place them onto these lending protocols. So there's very similar words to traditional financial actors, except that instead of having a firm managing it all, most of the mechanics is done on the blockchain. And that means that there's less operational risk, there's less mistakes, it's much more streamlined, and lower overhead, which means that you're able to get most of that benefit back to you in the form of higher yields. And as we mentioned before, because the frequency of these loans are extremely short-term in nature, there are no lockups. Funds are available to withdraw whenever you like, and you'll be able to get those funds back either through ACH or wire. I also wanted to show some of the other platforms that are available in terms of doing something similar. Some of these firms have not been very prudent with risk management, and so you might have heard some of these in the news. Celsius, Voyager, BlockFi, those three are completely bankrupt now. And Conduit and Meow are other competitors that have very similar features to us. But what we distinguish ourselves is that we rely on the power of blockchain technology to do the entirety of the management of the collateral lending process, which means that there's no humans to call, there's no specific relationship to say, oh, we're going to give you extra time to pay us back. It is very straightforward. The moment you don't meet your requirements, we call the funds back, we sell them, we get your principal back. So the testament is that in the recent times, even though crypto has been very volatile, Bitcoin has probably dropped 60 or 70%, we've been able to operate without any interruptions.
Ivan, I did have a question that came in. Which stable
Sure.
coins are invested in, and can we remove to our cold wallet if desired?
So because this is a private security regulated in the United States, you are sending us dollars and we're sending you back dollars. To be able to benefit from the tax deferral or tax freeness, obviously you have to do this through a self-directed IRA such as Advanta. So that's the way that we are dealing with that right now. This reduces some of the complexity with the regulations regarding AML and KYC that if you were to send funds that are not in the same form as what you've already received, there might be some implications of money transmission laws. And so that's why we do not do that. So part of the, yeah.
Go ahead, I'm sorry. Another question came in, so I'll wait.
Sure. So part of the issue is that some of these platforms, the way they've done it is there's really two tracks in terms of how this business operates. One is under the guise of the money transmission laws, and the other one is on the securities laws. In the money transmission laws, the way that they think about it is that everything is kind of like a physical good, like a gold watch or something like that. So if you're a pawn shop, you're a money transmitter because you're taking in, the gold watch and giving them money, or you're changing it for money. And so a lot of these platforms, since the IRA has ruled that Bitcoin is like a real asset, kind of like a commodity, that most people say, well, if I'm gonna take Bitcoin and I'm gonna pay interest on it, it's very similar to a pawn shop. So if I'm regulated under those things, then you can give me in kind whatever the asset is, and then I will pay interest in that denomination. So if you give me Bitcoin, maybe I'll pay interest in Bitcoin. If you give me dollar, USDC, which are stable coins, I will give the interest in kind in stable coins. Unfortunately, that interpretation of the law has been proven to be not quite correct. And in fact, BlockFi got sued for $100 million from the SEC as a result of them using that interpretation of the law. And we are actually been much more conservative in terms of our approach. It is a full security, it's a private investment. And as a result of security, we do not do any money transmission activities, which means we don't convert any cash for users. So they're not able to give us Bitcoin and we'll give them dollars. They're able to give us dollars and essentially earn income only. So that's how we've been able to make sure that we stay compliant with both the SEC as well as the money transmission laws across the states.
Oh, okay, and I have two questions. So were you able to, or can you highlight which stable coins are you invested in or you use for your liquidity pool?
Yes, we actually have it on our website. So if you go to pennyworks.com and if you click on how it works, we actually tell you specifically all the protocols that we use as well as the stable coins. So we want to be 100% transparent. You can do 100% of what we're doing and essentially get all of the yield. We're just trying to make your life easier since we've been doing this for a long time. That might not be necessarily your interest. You don't want to be spending time looking at it or making sure that you do due diligence. You might not know how to do the due diligence because that might require you to read smart contracts. So all these considerations are kind of what we bring to the table, but we're not saying, hey, look, this is a secret sauce that nobody else can do. We actually tell you what we do. That's part of this transparency goal that we have, see on this bullet point. We want to be fully transparent of how we invest and generate the income so that you have the peace of mind that the money is not coming from creative accounting or magic internet money.
Okay, next question is, if someone invested 100K 1 year ago, what was the ROI over that last year?
So we started opening up investments in April. So probably technically would not be able to invest starting in January. But I think our yields were ranging from about 5 to 8% annualized since April. So I think that's depending on the range what you would probably get.
Okay.
You might have gone like 3.5% or something if you start in late April or something like that, depending on the amount. Yeah.
Thank you.
Cool. Yeah, and so our rates are also published on our website, pennyworks.com/rates. They are floating rates, which is exactly what we're trying to make a commitment for. You're able to basically pull the money out whenever you like, and we reserve the right to change the rates whenever we feel like. But in practice, we reevaluate those rates on a monthly basis and see whether we need to tweak them or not. Cool. So pretty close to the end of the presentation. This is just a few slides about who we are and why we feel like we're able to manage these investments for folks. Previously, I was in traditional finance, both as a portfolio manager in large banks, and on the buy side as a prop trading firm. So we did both the high frequency, super short-term trading, as well as a very long-term asset allocation that banks need to do to make sure that they're able to serve their clients. We've also been involved in crypto for the better part of almost 10 years now, given that crypto hasn't been that long. And so we kind of straddle both of these worlds, and that's why we found that it was a very interesting opportunity for us to be able to bring that value add to folks. My co-founder, Carol, a similar background, much more on the regulatory side and risk management. So between the two of us, we cover most of the higher level functions of the bank in terms of both asset management, risk management, compliance, as well as the regulatory considerations.
We're good. We've allocated a full hour, so we're good on time. I have a next question. I have more questions, but the other one is, do you work with security tokens?
We don't work explicitly with security tokens simply because security tokens are actually, most of them are not on lending platforms. They're in trading platforms that are locked within a specific ATS, but they're not actually on the blockchains themselves in an open manner, which is why there are no markets that we could use those collateral as, use those tokens as collateral. The other issue is that their liquidity is just not very high. So the reason we only lend against very good collateral is because they trade like, $20 billion per day, right? So for example, Bitcoin daily average volume is like well over $5 to $10 billion. That means that if we need to liquidate the entirety of our investment, we can do that without any market impact. That's just not true if we were have to invest in these securities tokens that are not well traded. There's no way we can liquidate them. We couldn't liquidate them on Sunday night. They're not traded around that time. So it has some of the same limitations that stocks do in terms of traditional financial assets.
Okay, great. Next question is, are you regulated and how are you audited?
So we are regulated under the SEC. So the investments that we have are Reg D 506C investments, which means that part of the limitation is that we're limited to accredited investors only. So we both need to do a KYC AML check as well as proof of assets checks or the other eligible criteria for accredited investor status. We are not a money transmitter, as we mentioned before, simply because we do not permit the conversion of the asset or the cash into a different form of asset. So we don't fall under those rules. In terms of audit, we are just starting, so we have not gotten a full financial audit. But the idea is that our investments are actually on the blockchain. So it's not actually hard to check the balances that we have and assets on the blockchains directly, which is more transparent than an audit if you were just to do a private investment, actually.
Okay, next question is, just bear with me one moment. How much or what's the minimum amount for each investor that you're?
So we want to make this like a savings account in terms of the user experience. The minimum actually is only $500. It previously was $25,000, and we just dropped it because the idea is that you don't need to commit funds for a very long time. If you have a project, you can push the money out, do whatever other project you want, and if you have excess cash, you can push it back in. So the minimum is $500.
Okay, next question is, how do you communicate with your investors? Is it through emails or quarterly reports?
So we're pretty open. Like we both are accessible. So we provide a newsletter on a weekly basis that goes out on Monday morning, tells our investors about what we see in terms of the market. So there's a little bit of a color that I bring to the platform simply because of my background as portfolio manager. So very open to that. You can reach us by phone as well as by email. We're also available on social media platforms, so either LinkedIn, Twitter, Facebook, and Instagram. So whichever way that you prefer to communicate, we can communicate with you through that channel.
Okay, so this one is more so, I don't know if it's a question, but it's more so, it seems like it's a statement. So Treasury bonds pay more than PennyWorks. All clients 2.36% shown on your webpage.
Sorry, I didn't really hear that. So, for example, treasuries, 10-year treasuries right now is about 3.6%, which is, lower than the lowest tier that we offer, which is 4%, and then the highest tier that we offer is 6%. So, yes, treasury rates have gone up, and I think that's part of the reason. I think if you consider the relative value prop, right? 2 years ago, we would have been 6 or 7% higher than treasury bonds. Right now, we're about 2 and change higher than treasuries.
Okay, next question is, do I get to choose which stable coins my funds are invested in?
No, because the yields are highly localized. So there is a three-dimensional picture, if you like to think about it. It's got the blockchain, which is, for example, it could be Ethereum blockchain, Polygon, Optimism, Arbitrum. It could be the protocol, which is essentially the lending marketplaces. So there's a handful of those. And then it could be the actual asset that you're lending out, which could be the stable coins, which is USD from Circle, Tether, or DAI. And so if you think about all those three combinations, each one being a little marketplace, certain actors use certain specific sets of protocols and blockchains exclusively, and that's why the yields are dramatically different across these platforms. And so part of the work that we do in terms of bringing the value is that we constantly monitor those and rebalance across these platforms so that we can make sure that our investors are getting the most yields.
Okay, thank you. Next question is, what is the turnaround time to get my account set up and invest with PennyWorks?
We're very quick. So, if you were doing a non-IRA account, everything is self-service on our site. You could literally sign one up in the span of like 5 minutes. All we need is KYC and mail information, as well as proof of accredited investor status. That needs to be reviewed by a human, but typically the turnaround is less than 1 business day. We have all the forms provided to Advanta for their onboarding process. So if you do not have already a self-directed account, I imagine that there would be some overhead to set that up, but that would be outside of our control.
Thank you. My apologies for the background noise. So next question, just bear with me 1 moment. Can you recap the risk once more?
Yes. So we are a Reg D 506C security. So if you go onto our platform, you'll be able to see the PPM, which is like a 50-page document with all the risks inherent in investing in this product. The key ones that you need to be concerned about is the fact that this is blockchain technology, so it's very new. There is no third party. So we are a kind of you are interacting with us, so we are kind of a third party, so to speak, that's managing the investments. But we are not investing in traditional securities with broker dealers, right? So there's no broker dealer for us to call if something goes wrong, right? And the entirety of the platform that manages the collateral is on the blockchain. So the risk that you're taking will be smart contract risk, which is the fact that whether these contracts are implemented correctly. A lot of work is being done on our side to vet the platforms and the protocols to use, because we don't randomly use anything that has higher yield. And part of it is the fact that we've been in this space essentially since it started in the late 2018-19 timeframe. So we do audit those things, but that is essentially the risk, that you're investing in blockchain technology means that all the mechanics of your investments are on the blockchain. You're relying on the stable coin being stable, so that relies on those issuers. So that's USDC, Tether, DAI. You're relying on the blockchain itself continuing to operate, and that the risks are low, but it's a decentralized network. There's no guarantee that anybody has to keep operating it. If someday, for some reason, people just decide we don't want to do Bitcoin anymore, then yes, that would stop, and that would be a problem. So you are facing all the risks that are inherent in some in exposure to digital assets. But the nice thing is that you're not facing significant amount of market risk, right? So you're not buying Bitcoin and betting that it will go up by 10x. You're not buying Ethereum. You're not trying to find the next 100x coin. What you're saying is like, hey, look, you have good quality assets. Bitcoin's a $100 billion plus, it's a 300 billion or 500 billion, something like that asset, and that is the asset they're using as collateral for loans. These are dollar loans. and you're doing collateralized lending, which is one of the safest form of lending there is essentially in finance. So those are not as risky, but they're still kind of the exposure that you're getting in order for you to generate that income. Just really great questions, by the way.
Okay, I think that's the last question. Let's see, if you have any more questions, definitely feel free to put those in the question box. Let me go ahead and, okay, Ivan, I think that covers the question. Great information. The audience, if you have specific questions, again, about self-direction, definitely feel free to reach out to me. You can visit advantaira.com. If you want to know more about PennyWorks, feel free to reach out to Ivan. Here's his contact on my screen. You can visit their website, give them a call, or
also chat. Yes, if you want to chat, that's also go to PennyWorks.com. You can reach us out through chat.
Perfect. Yeah, no other questions came in. So I do want to thank you again once more. Thank you for the audience for listening in today, and I hope you all have a great holiday season, and look forward to for you guys joining us in 2023.
Much appreciated, Reneika. Thanks, guys.
My pleasure. Have a great one.